Hello, everybody. It's a pleasure to see you on this weekend, and I hope we'll have a good time learning the course of investment project management. And I would like to start this session reviewing the results of our knowledge test. So it's pretty fine. You can see that the most of the students pass the test, and as I said previously, we will not have any discrimination about the gradings, or all of those who participated here in test will be will count this test as successful, and we can go through the questions and just check what are the correct answers. So let's start reviewing the tests. I will open the chat window. Please, if you have any questions regarding the test, just write in the chat or raise a hand and ask your question. The typical order of process groups in a process life cycle. Yes, correct is initiation, planning, execution, controlling, closing. That's definitely, you cannot close until you execute and control. And of course, you cannot plan until you initiate the project. What is the best description of ramp-up phase of the project? Yes, it is a period from completing initial product development to maximum capacity utilization, characterized by product and process experimentation and improvements. So the period during which the project finance is drawn up and the project is built, it is a construction phase, so it's prior to ramp-up phase. The period of increase in a firm's production after anticipated increases in the product demand, it is not correct either, because on a ramp-up phase, we have an increase in a firm production ahead of anticipated increase in product demand. So we increase production, just anticipating that increase in the product demand will come. So we lead, not follow the product demand. What is the least common type of project commercial risk? Yeah, technological risk is not of one of the commercial risks. And obtaining the financing needed to fund the construction cost of a project requires satisfying prospective long-term lenders of the project. Yeah, technical feasibility, operational viability, and creditworthiness. So operational viability is more about the day-to-day management, but you definitely need to have an economic viability that includes many aspects, and of course operational results and efficiency too. But there is a lot of other things that can only be assessed in the process of getting the understanding either this project economic viable or not. Construction cost budget, economic viability and creditworthiness. Again, construction cost budget, it's a good financial characteristic of your technical solution, but technical feasibility includes a lot of other stuff to analyze and assess, not only the construction costs, like what is the actual operational process for construction, what is the technical solutions you employ, what already exists on the construction site, etc., etc., etc. Even like who owes the patent for your technical solution? Who is not a typical sponsors in the projects using project finance? Yeah, construction contractors can be sponsors, and it's a typical operators and maintenance contractors also, while end users of a project products and services, yes, it's typically not a sponsors. You can even qualify what can be exact end users of your projects and services in a phase where you're getting the project finance. What are traditional sources of private sector project finance debt? Commercial banks and bonds, that's correct. Commercial banks and equity, no. And equity is not a source of project finance debt. And the same for investment banks and its equity. The project finance is an attractive strategy to the sponsoring company that wishes to maintain operating control of the project and is willing to accept the complex contractual agreements, tight covenants, and close monitoring that project financing entails. Yes, that's true. That's the essence of an attractiveness for sponsoring company. What are mean and high debt levels of the project finance? Yeah, of course you can say that probably mean is 70 or 60, but definitely, and we solve the examples, the high debt level can be as high as 100%. So the answer is 70/100. Is it okay? Any questions regarding this quiz, regarding the answers? If any, please raise a hand or say that everything is okay. So please, any questions? Okay, let's move on. And today we will proceed for the next session, that is the session 3, formation of a project team, and what is exactly documentation that is being developed for management's investment decisions. Let's move on. Okay. So, like any other activity in a project management, using the project finance requires a systematic and well-organized approach to carrying out a complex series of interrelated tasks. The additional factor in the project finance is that the sponsors must be ready for outside parties, like lenders and the advisors that are to review and perhaps get closely involved in what the sponsors have been and are doing, a process that will take extra work and time. Finance can thus become a major critical path item. As with any new investment, the sponsors normally undertake a feasibility study when initially considering the investment. If project finance is being used, then structural requirements resulting from this study also need to be considered at this early stage, since these may affect the commercial approach to enhance the feasibility of the project. The sponsors need to set up a development team with a mixture of disciplines depending on the nature of the project. For example, design, engineering, construction, operations and maintenance issues, legal aspects, accounting and tax, financial structuring, and financial modeling. It is important that this team is well coordinated. One of the most common errors during project development is for the sponsors to agree on a project that is commercially sound, but not acceptable from a project finance point of view. For example, the fuel may be cheap, but supply contract does not cover the loan period, or construction contract may be at a low price, but the financial penalties on the construction contractor for failure to build on time or to specification are not adequate for lenders. As the sponsors do not have a necessarily in-house expertise to perform all these tasks, external advisors also have to be used. As the development process in all projects runs into months and on many projects into years, sponsors should not underestimate the scale of costs involved. High costs are unavoidable with the sponsor-owned development staff working on for a long period of time on one project, perhaps traveling extensively or setting up a local office. The costs of external advisors have to be added to this. Development cost can reach from 5 to 10% of the total project costs. And there is also always a risk that the project will not move forward, and all these costs will have to be written off. And that's the case in the most portion of the projects. So you should be very careful and clear about how high the development costs can run and what is the acceptable threshold for you. What is the role of advisors? Various external advisors are usually used by the sponsors during the project development and financing process. They can play a valuable role, especially if the sponsor has not undertaken many such projects in the past, since they will probably have had great experience in a variety of projects that the sponsors in-house staff. If a sponsor is not developing a continuous pipeline of projects, employing people with the necessary expertise just to work on one project may be difficult. Using advisors with a good record of working in successful projects also gives the project credibility with lenders. The sponsors may also make use of other project counterparts in advisory capacity. That is, even if the operational and maintenance contractor is not a sponsor, it may offer advice on the design of the project based on the practical experience of operating similar projects. The lenders use a parallel set of advisors to those employed by the sponsors as a part of the due diligence process. So we should keep in mind that the process of evaluating the projects and developing the project's framework is a parallel process for two teams, one from this project management side and the second team from the lender side. So they communicate closely with each other because In this type of projects, in this type of financing, the lenders heavily involved in all aspects of the project because the probability of getting back his cash flow stream is highly dependent on the economics of the project. So what is a financial advisor? Unless the sponsors are experienced in a project development, problems are highly likely to be caused by negotiating the project arrangements that are later found to be unacceptable to the banking market. Therefore, sponsors without in-house project finance expertise need finance advice to make sure that they're on the right track as they develop the project. Financial advisory services may be provided by banks, accounting firms, or advisory boutiques. Here the table showing top 20 financial advisors in the project finance market for mid-2010s, based on their size in the project finance at the project finance close. Banks are often act as a lead arrangers and the financial advisor combined. As can be seen from this table, the other major types of financial advisors are accounting firms, investment banks, and advisory boutiques. The financial advisor in the project finance has a more wide-ranging role that would be in the case of general corporate finance. The structure of the whole project must meet project finance requirements. So the financial advisor must anticipate all these issues that might arise during the lender's due diligence process, ensuring that they are addressed in the project's agreements, contracts, or elsewhere. The term of the financial advisor's engagement are set out in an advisory agreement, usually signed with the sponsors. The financial advisor scope of work under an advisory agreement typically includes advising on the optimum financial structure for the project, preparing a financial model for the project, assisting in the preparation of financial plan, advising on sources of debt and likely financing terms, advising on the financial implications of the project agreements, contracts, and assisting in their negotiation, preparing an information memorandum to present the project to the financial markets, advising on evaluating proposals for financing, advising on selection of commercial banks lenders or placement of bonds, assisting in negotiation of financing documentation. So financial advisors are usually paid by a combination of fixed or time-based retainer fees and a success fee on conclusion of the financing. Major out-of-pocket costs like travel are also paid by sponsors. The financial advisor obviously needs to have a good record of achieving successful closure of projects at the same time. And sponsors also need to ensure that the individual actually doing the work has this experience, rather than just relying on the general reputation and record of the financial advisor. So each key person from your advisory team should also have very sound reputation and relevant experience. You shouldn't rely only on the brand name of the company that provides advisory services, but you should carefully understand what will be the team of advisors working with you. These financial advisory services are usually essential to the successful development of the project, but they are necessarily expensive, costing around 1% of the debt amount on an average-sized project. However, in a large part of these may be success-based, and I should say from my experience, then presently this percentage can reach as high as 2% of the debt employed. For example, just imagine the some infrastructure projects, for example, in Russia, we have projects to build a toll road. Say the budget is around 200 billions of dollars. So 2% of that is $4 billion. It's quite a lot contract for any advisory company. So cost may be reduced by using smaller advisory boutiques or individual consultants, but less experienced developers may feel uneasy about not using the big name advisors. There is also always some risk that the financial advisor, however well qualified, thinks a project is financeable, but the lending market does not agree. There is also an application of very prominent rule in analyzing any types of agreements, models, etc. in the finance, called follow the money. So if you are getting the debt, so you're getting the money from a lender, then you should follow his requirement about how to present the project efficiency to the team. Then another type of advisor, it's a legal advisor. Legal advisors have to deal not only with project contracts, frameworks, etc., but also with how these interact with project finance requirements, as well as being familiar with project finance documentation. This work tends to be concentrated in a small pool of law firms who have built up the necessary mixture of expertise. You can see you can hear about some top names of American or British or other European firms, but we can see that in Russia we also have such a expertise developed. For example, we have Vegas Lex company that I work for 10 years with in various projects, and I can assure that, for example, the expertise of this company grows substantially over this period. Because so much of the project finance is about the structuring of the contracts, legal advisors play a key role. But their time needs to be used effectively, especially if they are paid for the time they spent working rather than by a fixed fee. For example, the lawyer should not be unnecessarily involved in making decisions about the commercial structure of the project and should not begin drafting contracts until the outline of the commercial deal is decided. On the other hand, lawyers' experience of commercial solutions in previous transactions can be very helpful to the sponsor in their negotiations. And there is also a problem of aligning interests of the party who pays, that is sponsors, and the party who being paid, that is legal advisors, on the amount of working hours spent on the project, because one party wants to spend as much as it can, that's lawyer legal advisor, and the other party that is a sponsor wants to cut it down as much as possible too. So be prepared to have a tough negotiation with legal advisors about the retainers, etc. We have other advisors on the projects. So various other advisors are usually retained. On the whole, their costs are much lower than those of the legal and finance or financial advisors. So it can be engineering advisors, environmental. In most countries, an environmental impact assessment is needed before any major project can proceed. For this, the sponsors will probably have to engage special advisors. environmental issues are of considerable importance for many lenders who do not want to be associated with projects causing environmental harm, even if they, as lenders, have no legal liability for that. And you can see the rise of ESG principles as a standard for ecological, social, and other types of best practices that the banks, the financial institutions, and other companies should follow. The market risk assessment. Market risk advisors are needed for aspects of the project not covered by contracts, like fuel supply, product offtake, traffic risks. If sponsors do not have their own expertise in the market concerned, the expertise of these advisors and the degree of their involvement in the project may be a significant factor for lenders' due diligence. We have accountants, and accountants are often retained to advise on the accounting and tax aspects of the projects, both for the project company and for the sponsors. And financial modeler, if the sponsor have enough confidence in their own ability to raise finance, they may not retain a financial advisor, but may still retain a financial modeler. This is usually an accounting firm or a modeling boutique. Okay, so that's the general overview how the project development team is combined. That what documentation we produce on the development phase. One of the starting point in the development process and the starting point in getting finance is a project proposal. The project proposal outlines your project's core value proposition. It sells value to both internal and external stakeholders. The intent of the proposal is to grab stakeholder and project sponsor attention. Once you have people's attention, the next step is getting them excited about the project. Getting in the hands of the people you're writing the proposal for so vital. You need to think like the project stakeholders to deliver a proposal which meets their needs. So you have to express your proposal, but express in words that are very familiar, that even comes from the mouth of your stakeholders. And the questions to consider when writing a project proposal, there are several key operational and strategic questions to consider. That includes core problem. What is the core problem you're trying to solve? Resources. What resources will be available? Timeline. What timeline are we work within? Budget. What budget do we have to work with? How does this affect our goal setting? Strategic goals. What are the strategic goals of our client? And how does our proposal align with those goals? Responsible parties. Who are the people responsible for the project? What are their goals and motivations? Client benefit. How will the client benefit from the completion of our project? What is their primary goal? Project deliverables and success. How will success of the project will be measured? What deliverables do our stakeholders expect to see at close? Let us also look at the project proposal elements and think about the examples of best practice for writing a proposal. And then I will show you some examples from my experience, how this proposal can look like. All project proposals have 6 elements which construct the proposal's foundation. These 6 elements offer well constructed proposal can be executive summary. The executive summary captures the attention of your audience. The goal is to get them excited about the projects you are proposing. It is essentially the elevator pitch for the project. It should be short and to the point. The summary should be descriptive and paint a picture of what success looks like for the client. Most importantly, it should motivate the client. After all, the goal is to getting them to sign on the dotted line to get the project moving. History. The history section outlines previously successful projects. It's also what outlines those that could have run more smoothly. But doing so, this section establishes precedents, namely how the next project can be more effective using information from previous projects. Then requirements. Requirements are the items, materials, and resources needed for the project. This section should cover both internal and external needs. The solution. Solution section addresses how your project will solve the client's problem. Accordingly, this section includes any project management techniques, skills, and procedures your team will use to work efficiently. Authorization. This section covers who the decision makers are on the project team, and also covers which stakeholders have sign-off authority on the client's side. Appendix. Information not included in the project proposal is a part of the appendix. It's where many of the more interesting details of a project are located. Also, it's where team members and stakeholders can do a deep dive to learn more. And project proposal format and best practices. When building your project proposal, you should contain a cover letter, table of contents, executive summary, description of the project, project plan, who is involved and in what capacity, where the project will take place, how it will be monitored, the budget proposal, and other attachments in appendix. Types. In terms of types of proposals, you can have one that is formally or informally solicited, unsolicited, or a continuation. There can be also renewal proposals or supplemental proposals. And here are some tips. Whatever proposal you are working on, there'll be a few tips that apply as best practice for all. Just remember, if you're trying to win over stakeholders, not borrow them. Speaking of stakeholders, do research. You want to address the right ones. There is no point in doing all work necessary to write a great proposal only to have it directed to the wrong people. Whoever is going to read it, they should be able to comprehend the proposal. Keep the language simple and direct. When it comes to writing, get a professional. Even a business document like a proposal will suffer if it is poorly constructed, has typos, or impenetrable. If you don't want to hire a professional business writer, make sure you get someone on your team to copy, edit, or improve the document. The more eyes on it, the less likely mistakes will make to the final edition. While you want to keep the proposal short and sweet, it helps to sweeten the pot by adding customer testimonials to the attachments. Nothing sells a project better than a customer base looking for your product or service. You will have all these detailed explanation about the advisors, the contents of the project proposal, the project proposal tips as a footnotes for your slides when it comes to it. So now I would like to share with you my experience of writing the project proposals. Can you see the screen now? It's in Russian, but I will translate it. So you just need to grab the structure of project proposal, and it's how contents of this proposal is presented. So it's the name of the projects, discussion materials. Here we showing the very core of the project. So what is it about? Its explanation. What is it about? You see that it's only 3 lines. And also we have an actual status of the project and the history all in one slide. What is done, what is planned, what is the actual status. So we have authorization from authorities in the Russian Federation. We are developed MVP and we are ready to roll out it. So it's a summary, 1 page that gives you a total overview of the project, its core, its authorization, its history, and the planned stages. Then the financials. You will get this amount of, you need to pay this amount of money, you already paid this, you will get that. Sensitivity metrics, and we'll talk in detail later for this. So you have the very important efficiency measure like IRR, and you have various parameters that can affect your results. And here the results and what is the actual effect on IRR with different combination of parameters. So the top manager who takes the decision could decide what is the actual boundaries of performance he can accept and what is the parameters for these boundaries are. Then again, sensitivity metrics for other key factors like operational expenses, capital expenses, then the sensitivity for the market changes, and again, then sensitivity for the roll-up procedures. Shall we start from that percentage of market, that's it. And the financial model, it can be as detailed as you can, and a lot of appendixes, all the details. Another example that can be the part of research, justifying your proposal or providing more information to the sponsors. Remember this VR project I mentioned to you on first session. So it was the research that underlies the proposal of producing the VR solution that I mentioned. So diving into market of VR ecosystem, you can see the summary again. The reader, the top manager should get the summary of this research, the resume from the first page. Then it is a landscape, the overview of ecosystem of VR. It's very touchy. You see all concept in very simplistic, but right to the point icons, graphs, additional additional elements like boxes to emphasize the outcome of the slide, etc. And another story that you shouldn't have a lot of colors in your presentation or in any graphical representation of your document, because as much if you get a lot of colors in your presentations, it will be even sometimes get not only worried, but can cause a pain for the reader to keep in mind a lot of colors on the same page. And also there's a good approach to have not only pluses and pros and cons, but also in examples that exist on market. So you embed your research within the existing market, who the actors, who the competitors, who the partners, etc. then your current understanding of your audience. What is the groups? What is the target groups? What are the specific characteristics? And what is the financial implications of it? And here are the outlook of how some strengths and weaknesses, opportunities and threats can be managed in the coming years. So it's a midterm perspective from 3 to 5 years. And also graphs, figures, etc., etc. So very good comprehensive market research. But you see, that's a summary, that's the landscape, then the figures for that's the users, and so that's the financial result. Only 6 slides. That's from my perspective, it's quite optimal for top manager to read and to understand. And all the details, you can go to the appendixes. You can write very good and detailed representation of your idea, etc., etc., etc. But it's not for the top manager. It is for his team to dive in, to get acquainted with your solution, and to present review or third-party opinion for his or her boss. So if you have any questions, please raise a hand or type in a chat. We'll have a short break for 5 or 4 or 5 minutes to again to refresh yourself, to get a cup of coffee or tea. So please come back in 5 minutes. Hello again, back to the study. Then the next document that is being developed on a development phase is a business plan. So best practice of project development usually involves formal reviews and approvals at various stages of the project development process, which provide the basis for moving forward to the next stage. And the typical stages are initial business case or business plan that looks at the project from a high level to confirm that it fits into corporate government strategy, considers the various options for achieving the project, typically fairly short and simple. If initial business case is approved, the counterparties normally engage external advisor at this point, and this analysis may also be described as a pre-feasibility study or strategic business case or strategic business plan. The outline business case considers in detail the need of for the project based on the cost-benefit analysis. Based on this, the scope and estimated costs of the project are estimated in detail, and financial model based on these estimates is prepared. This model takes account of estimated capital costs and lifetime operating costs of the project and the likely structure of costs of the project finance, and thus estimating the total cost of the project over its life. The models, therefore, will enable to decide whether the project is affordable or not. Quantification of risk and optimist bias, that is tendency to overestimate usage of a project and underestimate its costs, to make such adjustment is difficult to do with the real accuracy. And it is easy to encounter the detailed numbers in the outline business case. So not be 100% sure about the figures your team or your counterparty put in the financial models. All these figures can be, firstly, subject to the biases, and one of these biases is optimism bias, and then can be affected by the actual changes on in a life cycle of the project. Then this next stage for the business plan is a readiness for market, and the commonest error made is a lack of adequate preparation before approaching the market, known as the project preparation gap. This may not be the fault of the project team. The corporate or political pressure may lead to a requirement to be seen as to be doing something, or behind the scenes preparation work is not conspicuous enough to meet such an imperative. So you are already incited the sponsors, either it's a corporate sponsors or public sports political counterparties, and they already want to push you to make the project decision in as fast as they can, not you, but and you're forced to probably to omit some very necessary stages in assessing the market feasibility of the project. That's known as a project preparation gap, and you should do as much as you can to close this gap, or to get your counterparties, your sponsors, understand the implication of having such a gap. So in fact, through our procurement, there is likely to be conflicts between a given timetable and realistic and prudent approach. As the part of the preparation process, the project needs to be structured to ensure that it is in fact attract finance, that is, the risk to be bankable. This may involve preliminary market testing, sometimes called soft market testing, sometimes inviting prospective bidders to provide an expression of interest. to check that there is a market appetite for this investment and its financing. And also that potential contractors with relevant expertise are interested in joining bids for this project. A formal presentation of the project to all interested parties may be organized at this stage. And then we have a final business case, final business plan that takes account of the changes that have been taking place in the project structure, risk transfer, and costs since the initial or outline business cases, with the aim of confirming that the original basis on which the project was approved still applies. And then we go to investment memorandum. There's also several stages in getting the investment memorandum. So there is a preliminary investment memorandum that originally prepared by the sponsors of the financial advisors to present the project to prospective lead arrangers. The lead arrangers prepare a package of information to facilitate the syndication and the lending process. Syndication is getting the pool of lenders, especially for large projects. And at the heart of which, the heart of this process, is the final investment memorandum lies. So, if we talk about the investment memorandum and consider that, keeping in mind that it has several stages of development, like the preliminary, intermediate, and the final memorandum, there is a some requirements for investment memorandums that apply for all the stages. The investment memorandum should provide a detailed summary of the transaction, including a summary overview of the project, its general background, the term sheet, the project company, its ownership, organization, management, financial and other information on sponsors and other major project parties, including the experience in a similar project and the nature of the involvement and support for the current project. Technical description of the construction and operation of the project. Market situation, so that is a commercial basis for the project. And where relevant, this market situation should cover aspects such as supply and demand, competition, other issues for the project, etc. The summary of project contracts, so the main terms, the outcomes, the cost of the project contracts, the counterparties, etc. Project costs and financing plan. So what is the project costs? The breakdown of project costs and the actual plan for finance, when you expect to draw down the needed finance and when you expect to repay this finance provided. Risk analysis, very important, and financial analysis included the financial model that we develop on the base case for base business plan and its sensitivity analysis. In other words, the investment memorandum provides a synopsis of the structure of the project and the whole due diligence process, which speeds up the credit analysis for prospective participants, that is lenders. If the project memorandum well organized and written, it also provides the project company staff with a useful long-term reference manual on the project financing. The information memorandum is accomplished by supplementary reports and information, which may include legal advisors may provide a summary of legal aspects of project, a technical report from lenders engineers summarizing the due diligence review, so the view on a technical aspect of the project from the lending party, a report on assurances from insurance advisor, a copy of financial model with a model auditor's report, advisor's report on the market in which the project is operating and its revenue projections. So your financial model is probably will be reviewed by the third party, like team or advisor for the lending party to say that the model is sound, no modeling mistakes, your assessment of the market is good, you correctly translate all the parameters of the market, of your product, of your costs into the financial model, nothing left behind, nothing additional include, etc., etc., etc. And also, what can maybe include a supplementary documents for an information memorandum. It's a similar market report on the fuel, raw materials, input supplies. So some review of key resources involved in the project also can be made. Environmental impact assessment, annual reports, and other financial information on the various parties of the project. The sponsors and the project's company are actively involved in the production of the information memorandum, which is normally subject to the approval and confirmation of its accuracy. Let me show you the example from my experience. Remember this very large project with Rosnano. So it's investment institution, development investment institution for high-tech projects in Russian Federation, and this project of building a manufacturing plant for semiconductor with topology of 90 nanometers. Here is the investment memorandum. It's also in Russian, and I will translate the general contents of it. So you can see, the whole screen from my PC, or also with these steps about the chart and the participants of our call. So nothing left behind this pop-up windows. No problem to read the contents here, for example. Okay, so the project summary, then the market with the global market for semiconductor manufacturing, the business model of the market, the Russian, so the local market where we operate, then the project. What's the operational model for the project? What's the management project of the project? What are the business partners? Results of their expertise. How the intellectual property issues are dealt. Calendar schedule for project. Then financial forecasts. Revenue, costs, other revenues, operational expenses, interest expense, taxes, capital expenditures, intangible assets, etc. Financial cash flows, the dividends, and the financial performance indicators and financial forecasts. Then deal structuring, how we will deal. So the general deal structure, the drawdown procedure, corporate governance, how we will deal with issues regarding the shares of the partners in the company, the control issues, exit issues, option agreements, efficiency assessment, risks, and appendixes. And just let us have a look on the size of this document and touch its contents. So it's not only a few words, not only a few tables, it's about 200 of pages, and all contains very important, very valuable details of the project. Of course, because you are bidding for $200 billion. So you can see just that's the approach. That's the summary. So 10 pages for executive summary here, or even 12 pages for executive summary. Then the market research, a lot of stuff. So the forecast, the actual solution that exists on the market, the application of the production that will be produced by this manufacturing client, the possible customers, the partners, our competitors. Again, another solution that can use the product of this semiconductor line. Also, who is using some SIM cards, very acquainted with this pattern. So you know that it's about half of chips for SIM cards that used by Russian operators produced now by this semiconductor line. Etc. 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 Let's go further to from market research. All GLONASS chips are produced here. Bank cards, credit card have a chip embedded in a card that's produced by this semiconductor manufacturing line. So even in the electronic type of your documents or your original documents that have embedded security chips, all here. So even at the stages when you're just receiving the finance or try to receive finance, you should clearly understand what will be your markets for the 10 years, for the 20 years. Your competitors, it's other company that's competitor to this one. Then you see 74 pages for market research. Then go for the project definition and description, how it works, who will work on this project, so financing party, technological party, operational parties, products, equipment that will be purchased, all the operational organization like production line, IT infrastructure, some specific requirements for this industrial solution like clean rooms, life cycle for the product. All these stages of running the product, so like construction, then roll up, then operational phases, recurrent activities, etc. All the technical details that can be reviewed and considered by the technical advisors. So because for this project, the technical issue is really important. In a semiconductor industry, the technical solutions are getting absolute on mean in 3 to 5 years. So if you have, for example, some semiconductor manufacturer that use the topology as it was in 2012, 90 nanometers, that probably in 3 to 4 years, say in year 2014, this technology will be absolute. And that's the case. We already run the topology of 45 nanometers in 2016, then topology of 28 nanometers in 2018, and now we even have a topology of 18 nanometers in our PC already manufactured and installed. Etc. 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 So the technological risks are very essential for such products. Then you have the organizational structure, you have a detailed explanation, what are your staff, what's the roles, how many people working in each specific department, their salaries, their responsibility, management structure, the key managers, a lot. Project plan, financials. That was part that was produced by me. Revenues, sales plan, prices, costs, etc., 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 etc. Then how we'll use the finance provided, what equipment executive will receive, what will be the price, what will be the installation costs, what will be the timing of these installation shipments, etc. Very detailed. And here it goes, the structuring issue. So all the legal and shareholders issues here, how it will be financed, who will participate, some additional assurances needed, what the financial figures, what the lending terms, how it can be actually draw down from the lender, and efficiency assessments. And you can see the financial figures here, the risks, a lot of risks, operational risks, market risks, credit risks, etc., etc. A lot of other stuff and appendixes. So you now have an impression how detailed and how sophisticated the investment memorandum can be, and it's only one of the heavy bunch of documents need to be developed to get a finance. And what comes next? The presentation and a roadshow. So a formal presentation may be made to prospective participants, banks, by lead arrangers, the sponsors, and other relevant project parties, sometimes through a roadshow in a different financial centers. Prospective participant banks are usually given 3 to 4 weeks to absorb this information and to come to decision whether to participate in the financing. They are generally given the documentation to review after they have taken this decision in principle to participate, and may sign up for the financing 2 or 3 weeks after receiving this. Then some words about the financial model, because it's our primary occupation in this process as a financial professional, to develop a financial model. And a financial model is an essential tool for any project financing. It serves a variety of purposes. On a stage of pre-financial close and during the development phase, a financial model is needed for initial evaluation and re-evaluation of the project's financial aspects and returns for the sponsors, to structuring the finance and reviewing the benefits to the sponsors of different financial terms, formulating the financial provisions of the project contracts, can be a part of the lender's due diligence process and used to quantify critical issues in the finance negotiations. On the post-financing close phase, the financial model continues to have a role after financial close as a budgeting tool. It's enabling lenders to review the changing long-term prospects of the project and thus the continuing exposure, and also enabling investors to calculate the value of their investment. Although separate and parallel financial models may be developed by the sponsors and the lenders, it is often more efficient for a single model to be developed jointly. This may mean that the sponsors develop the model initially and then work on it jointly with lenders, depending on the timing of the lenders' involvement in the project. The sponsors may then use the model to calculate their own returns, taking into account the ownership structure of the project company, the results of which are not concerned to the lenders. However, by financial close, there needs to be one model agreed between the project company and the lenders for the purposes we mentioned above. Let us discuss what are the inputs for the financial model. The input assumptions for the financial model for the project company can be classified into 5 main areas: macroeconomic assumptions, project costs and funding structure, operating revenues and costs, loan drawings, debt service, taxation, and accounting. The basis for the inputs must be clearly documented. The standard way of doing this is for an assumption book to be compiled. This takes each line of the financial model and sets out the source for the input or calculation of that line, with copies to the documentation to back up these calculations. The main categories of inputs are usually entered in separate input sheets, that is one for specific assumptions such as project costs, and one for long-term macroeconomic and operating assumptions that covers the life of the project. Inputs should be not scattered throughout the model, and someone not familiar with it will find it much harder to understand what is going on if it is put it on various pages. To calculate the investor's returns correctly, the financial model should cover the whole period from when the initial development costs on the project are incurred to the end of the project life. And the project life is either the term of the project agreement or the expected economic life of the project or its solution, etc. Let's go in detail for these macroeconomic inputs. The macroeconomic input assumptions are those that are not directly related to the project, but that affect the financial results. Such assumptions may include inflation, commodity prices, interest rates, exchange rates, economic growth, and ideally, macroeconomic assumptions for modeling projections should be taken from an objective source. For example, most major banks produce general economic research with generic projections that can be used for these purposes, although it is unlikely to extend for the full term of a model. And also now not only major banks, but development corporation and even some governmental bodies like Ministry for Development or Ministry for Economic produce such an assumptions that can be used as assumptions in a model. The next stage in the detailed modeling process is the preparation of budget for construction costs from the project company point of view and determining how these are to be financed and how this finance is to be drawn down. The cost budget takes into account costs incurred since the beginning of the project development and covers the period until the project is complete and ready to operate. A typical budget for a process plant or infrastructure project is likely to include: first, development costs. These are the costs incurred by sponsors or by project company itself in the period prior to financial close. Sponsors need to agree among themselves to a methodology for allocating their own costs to the projects, including staff overheads and the travel costs, which are likely to be significant over a long development period. Costs of the sponsors and lenders advisors also need to be taken into account. Then goes development fees. The project economics may also allow one or more sponsors to take out an initial fee from the project company for developing the project, and thus realize an upfront profit. These figures may fluctuate or be eliminated entirely as the financial evaluation of the project and hence the ability to finance such a fee develops. Then project company costs. These are the project company's direct costs incurred by the project company after financial close, rather than those payable to subcontractors, advisors, insurers, and lenders. And these costs such as personal costs, office and equipment, costs for permits and licenses, owner engineers costs for construction supervision, training and mobilization costs. Another portion of our budget is construction contract price. You should be careful about calculating. Then construction phase insurance premium. You should always keep in mind that you should cover some or mitigate some construction risks by paying the insurance premiums, entering insurance contracts. Then goes startup costs. These are the costs for any fuel, raw materials used by the construction contractor during the testing and startup of the project. So you have to fuel your car, you have to fuel your bus fleet, you have to pay for some oils and other materials just to run, just to get your vehicles from the supplier to your hangar, just to roll for the initial tracking, for initial run of any equipment, either it's a vehicles, either it's a printing press, something else. Initial spares. These are the cost of initial stock of spare parts. Initial working capital. The working capital requires for operation of the project and the amount of money required to cover the time difference over the project's company invoicing cycle between payments and operating costs and receipt of the revenue in cash. In effect, it is the short-term, usually from 30 to 60-day cash flow cycle of the project, which cannot be calculated directly in a financial model that runs for 6 months period during the operation phase of the project. The initial working capital requirement can be calculated as the non-construction related costs that the project company has to incur until it receives its first revenue. So it's just cash cushion for your initial period until you receive substantial revenue. And if you are not increased your costs substantially, then probably this initial working capital will be enough. But in some projects, you have a gradual increase of costs ahead of revenues. So from time to time, you have to add some funding to your working capital. So there is such a types of the projects. And what can be included in the working capital? The costs for initial inventories of fuel and other raw materials, the first operating insurance premium, any timing difference between payment for input supplies and product outputs. So changes in the amount of working capital required are usually a major product of a product of movements in sales or purchases of input supplies, which should be reflected in the general cash flow. So if you change the supply agreement with your counterparty, saying that, okay, something changed on the market, you should pay in advance for the whole year, while previously you're paying on a quarter basis. That means you have to raise your working capital just to pay the bulk of money in a beginning of year, and then you will have additional cash flow. So you have somehow increase your working capital one time to allow additional money cushion for these changes in the contractual obligations. But all these changes should be definitely anticipated. Then it goes for taxes. This includes taxes payable during construction on the various project costs such as VAT or other sales taxes and import duties, and of course financing costs. That includes interest during construction, loan arrangement and underwriting fees, commitment fees, loan agency fees, additional debt-related costs, funding of reserve accounts, security registration costs, costs of lenders and advisors. And last but not the least, contingency. Any contingency reserve needs to be added to the project cost. Okay, let us have a break here, and in 5 minutes we will continue the topic about the financial model. Okay. Okay, let us move forward. Then we have key operational assumptions. And the first stage in projecting the operating revenues and costs in the model is to identify the key operating assumptions. For example, what are the initial output? How does this output change over time? How much the time is needed for maintenance? How much time should be also allowed for unexpected downtime? What is the rate of consumption of fuel and raw materials? How does this consumption change over time? Based on this, the main elements of operating cash flow may include operating revenues from sales of products minus cost of goods sold, cost of fuel material, the project company own operating costs, maintenance and life cycle renewal costs, insurance premiums. And having determined the net operating cash flow from all above, the model then calculates the interest payment and other sums due to the lenders, allowing for hedging contracts. And we come to the financial model outputs. It's a series of calculations for investment budget. And there is also financing form that state the drawdown of equity and repayment of debt and interest calculations. The expenditure form, operating revenues and costs also, the tax form, profit and loss statement, balance sheet, cash flow, the very important part of the financial models, because all your assessment, all the efficiency of proposed project based on the cash flows, when you are receiving cash, when you are paying in cash. Lenders cover ratios, and a summary sheet usually sets out the key results in one page, such as summary of project costs and funding, cash flow summary, lenders cover ratios, projects NPV and IRR, probably other ratios. And we have a sensitivity analysis. The financial model also needs to be sufficiently flexible to allow both investors and lenders to calculate a series of sensitivities showing the effects of variations and the key input assumptions when initially reviewing the project. Such sensitivities may include calculating the effect on cover ratios and IRR of such drivers like construction costs overrun, delay in project completion, reduction in performance, higher downtime or lower availability, reduced volume of sales or usage of the product, reduced sale prices, higher input costs, higher operating costs, high interest rates, higher and low inflation, and exchange rate movements. Let us see how the actual financial model can look like. I'd like to present your the branded model of one project I run. So I'll try to hide the actual figures first. Just wait a minute. It's very heavy financial model, but it will give you the understanding how it works. Okay. So can you see the spreadsheet with financial model here? Yes, no? Good. So you can see it is financial model, and I will rerun it to have all the names in English. So it's one of the malls the company I was worked for constructed. You can see that there is a special page for assumptions, again, special page for summary, then performance indicators and performance for investors, the marketing side, operating income, operating expenses, equity and financing, sensitivity analysis. What is important for real estate's valuation page, capex expenditures, and the financial statement, P&L, cash flow, balance sheet, also some specific instruments for real estate, that is rent roll, that is detailed roster of all the tenants and the lease agreements and the proposed projected revenue, the timeline, staff, taxes, and all the types of analysis. Let's have a look at this. So you can see again here that assumptions for macroeconomic, for some quantitative parameters, marketing parameters, operational parameters, financial parameters like the terms for credits, for loans from stakeholders, the dividend policy, etc. Valuation parameters, seasonality is mainly for projections of income. And you also can look how the summary maybe. I'll shorten it. So you have the quantitative parameters indicating the size of your business, like gross building area, gross leasable area, some marketing parameters, then operational performance, your investment running total, you have bank loans outstanding, you have performance with various measures that will be discussed in the next session. And that is, then you can go back and you can have a look at, for example, operating income, what it is constitute of. So it's a rent, some other sources like operating and maintenance, so auxiliary services, marketing as auxiliary services, and parking, so parking lot revenues. The same for operating expenses. So the recurrent activity, area plot, land plot lease, maintenance, current repairs, security, cleaning, insurance, etc., etc., etc. Again, the payments, the bank expenses, and it's all lead to a cash flow statement. You have operating inflows, outflows, investment activities, and it goes to the net cash flow, free cash flow, that can be used at the base for calculating of attractiveness and efficiency of each project. But in real estate, there are really specific approach for calculating the attractiveness and performance of real estate. I understand that most of you also joining me on the course of alternative investments, and we'll discuss in detail how the performance of real estate are valued and what exact techniques are applied for this. You have, then you can probably notice this figure, these letters and these words in the course of that sessions devoted to alternative investments. So to calculate the performance, we have first to calculate some operational parameters like net operating income, its margin, EBIT, net profit and loss. This efficiency measures the cash measure, cash on cash, the IRR, then the parameters used for valuation like a cap rate. Then you have your financial stability ratios, LTV, LTC, etc., etc., etc. And we can see also it's a view on a performance of a project, not an investment view on the performance of investment. investment. And here we can look at the view from investor's perspective. So you have cash flow, you have investments, and you have return on investments, and you have all the indicators of performance calculated for investors, like zero cash and cash. So they draw down the money, then they receive the return on the investment. What is the actual efficiency in terms of cash, in terms of IRR, what the value of their equity, what the growth of their equity, so how fast the capital appreciate in this project, and what is the payback period. So all these are very actual. So from the real life, nothing is artificial. This mall exists. It's in Sochi. Probably some of you already visited this mall, because if you are in Sochi, it's the only mall you can visit. And also a lot of stuff. This how the financial model can look, and it's very detailed model for setup business. While on the initial stages of your financial model, so your projects, it can be shorter, but it will grow more and more. You will get more details as your projects mature. And for example, this model, probably some of you who are acquainted with any size figures used by Microsoft Excel, it's pretty huge. So 40 gigabytes or 40 megabytes. Okay, let's come back to the session, and now I would like to run a quiz and paste it with you. So please wake up if any of you get asleep for my monotonous lecture. So do you have the link to the room? If anyone doesn't have the link to the room that is named Gorshenin, please let me know and I will send you. Okay, no problem. Here it is. Let's launch a quiz. And then it will be a knowledge check that will be pasted with me. Okay, let's start. We will count how many participants we have. It's 64. So let us proceed to the next question when we have at least 30 answers received. Okay. So again, no worries about if you answer it wrongly, no problem. It's just checking our knowledge, how good you get the contents of the lecture. Okay. So you see that the answers A and C have some disciplines of the development that are not common for generic project. Like, yes, you have to have engineering and construction, legal, accounting and tax, but media support is not actually the one of the disciplines that are that need to be having a team for any project. So it's uncommon one. And also there is history of IT infrastructure and development. Really, it's not uncommon for the project, but of course, someone may argue that in the recent years, the importance of IT team and IT infrastructure is growing and growing. But again, probably the things will change, but now it's not a common discipline of development team. Let's move on. Okay, let us check the results. Yeah, definitely the advising to a local authority for public hearing is not all the project finance business, and the advice on going for IPO, yes, it can be the financial advisor role, but it's only for a settled business who goes public, not for the project finance. Okay, move on. Okay, let's check the results. Yes, all right. The detailed operational workflow is not of the business for project proposal. Project proposal has to be pitched presentation, straight to the formula. You sell the project to the sponsor, to the lender. Nobody really wants to go into deep dive into detailed operational workflow of the project to take a decision whether it should go for the project, whether it should finance or not. Then in an investment memorandum or at some operational plan, you can explain it detail, but not in a project proposal. Go on. Okay. So, very interesting. Please share your opinion, especially those who selected answers B and C. Why you think that the best description of the project proposals elements are executive summary, history, requirements, and a draft contract? Or just like requirements, solution, appendix, and project credentials. So can someone say while draft contract or project credentials are an essential part of the project proposal? Any thoughts? Okay. Yeah, that's correct. It should be featured. It's fine, but okay, probably in this case, if we compare the answers A and B and say the appendix contains a lot of information and it's valuable for not the top managers but for their team of specialists, probably yes, but you see the other moment that the project has its credentials. That mean who runs the project, how it calls, probably where it's situated, what the naming, what probably some other history. But what about the financials? What about the story that needs to be presented for the top manager? What he can invest and what he will get from it. Do you think that he or she will go directly to appendix? Probably not. So I think that on the top of the project proposal, there should be executive summary answering the general questions from the top manager. What it is about? What will I get from it? What it will cost me? And what is the risks? And all other things can be discussed later. But if he or she didn't have persuaded about that it's attractive for him, in not only in terms of the exact core problem solved, etc., but also in terms of money, I think nobody will go into detail until it's persuaded on the basis of money invested. And of course, this draft contract probably can be the part of the project proposal, but I think at the part of at the time of project proposal, you can't really provide a good draft contract. And also all these other things. You should present solution, but not a draft contract in a project proposal. So not go in details, not go into legal aspects or some modeling aspects. So be pitched, be precise, but very demoable and saleable. Okay, let's move on. Let's check. Ah, good. Yeah, term sheet should be the part of investment memorandum because it's starting point our negotiation, and risk analysis, of course. But the product design templates can be, and you already saw it in the investment memorandum I show you today. But it's not. It's least likely to be one of these three results. Okay. Yeah, definitely the project's financial model is used on a whole life cycle of the project. It's really rare when you produce a financial model only for financial close, and it's even impossible to have it only on post-financial close stage. Okay. Fine. Yeah. Yeah, perfectly clear. The churn rates, it's deal with the outflow of your customers, but it's not from macroeconomic input assumptions. Okay. Yeah, you're perfectly correct. The best description, it's reforms, income statement, cash flow statement, and a balance sheet, while the profit and loss that is the same as the income statement and cash flow are. There is an answer A, but the capex, yes, it's one of the outputs for a financial model. But for example, if you have a financial model for the project that it's not capex intensive, you shouldn't have a capex in it. So the correct answer is C. That's all for the quiz. How it was? Any questions? Any suggestions? Any ideas? So have you had a fun answering this quiz? Okay. So thanks. Let us have another break. Will be enough for you to have a 7 minutes break, or we have a bit longer, say for 12. So shall we meet at 3:05 or 3:10? Okay, 3:10 then. So meet you in 12 minutes. Okay, so do you have any other questions regarding these quizzes, regarding scores, etc.? If no, let's move on. And we have a session devoted to the selection of project process and what are the selection criteria for the investment projects can be. So analysts use several important criteria to evaluate capital investments. The two most comprehensive measures of whether a project is profitable or unprofitable are the net present value, or NPV, and the internal rate of return, or IRR. In addition to these, we can present four other criteria that are frequently used: the payback period, discounted payback period, average accounting rate of return, and profitability index. An analyst must fully understand the economic logic behind each of these investment decision criteria, as well as its strengths and limitations in practice. Less common but extensively used in specific investments are following criteria: return on investment, or ROI, return on equity, or ROE, and cash-on-cash ratio. For example, in real estate, the cash-on-cash is heavily used, and IRR too. So probably many of you already acquainted with this very popular definitions and calculations, but nevertheless, let us have a brief overview of what it's all about. So for a project with one investment outlay made initially, the net present value is the present value of the future after-tax cash flows minus the investment outlay, or this formula that we have here, and we are CFSA. After-tax cash flows R is required rate of return, and outlay the investment cash flow at times 0. And very simple example of Gerhard Corporation that considered investment on 15 million, a capital project with return of the tax cash flow of 60 million per year for the next 4 years, plus another 20 million in a year 5. The required rate of the this investment is 10%. Very simple and straightforward calculation that leads us to the NPV of around 30 million. That means that it's positive effect for the company. Then very simple decision rule when you are using NPV. So you invest if NPV greater than 0. You shouldn't invest if NPV is less than 0. So the positive NPV increments are wealth increasing, negative investments are wealth decreasing. And total rate, there's some formulas that can be used for you as a generalization for NPV. So you have, if you will notice the net cash flow for each specific period as CF at time t, then the general NPV can be summarized as the sum from time 0 to time n of all these cash flows divided by the compounded rate of compounded discount factor. An internal rate of return is one of the most frequently used concepts in the investment profitability analysis. The internal rate of return definition is one that all analysts know by heart. On the left hand side of this equation is the present value of the future cash flows. So it's the top equations, which discounted at the IRR equals the investment outlay. So the value for IRR can be found using some iterative algorithms. So there is no analytical way of deriving IRR, and that's why the IRR have some limitations for years. And the decision rule for IRR, again, is pretty simple. We should invest if IRR is greater than our required rate of return, and shouldn't invest if the IRR is less than required rate of return. That is often termed as a hurdle rate. And again, from the course on alternative investments, you can be familiar with this notation, the hurdle rate. Many investors have cash flows patterns in which the outlays occurs time zero in the future days, and the common is to define IRR as the discount rate that makes the sum of the present values of all cash flows to zero. And we have a ranking conflict between the NPV and IRR, and here is the example. So for a single conventional project, the NPV and IRR will agree on whether to invest or not to invest. For independent conventional projects, no conflict exists between the decision rules for NPV and IRR. However, in the case of two mutually exclusive projects, the two criteria will sometimes disagree. So in this example, project A might be larger with its NPV than the project B. The project B has a higher IRR than project A. In this case, should you invest in project A or in project B? Differing cash flow patterns can cause two projects to rank differently with the NPV and IRR. Suppose project A has shorter time payoffs than project B. This situation is presented in this table, and project A and B have similar outlays but different patterns of future cash flows. Project A realizes most of these cash payouts earlier than the project B. So the cash flows as well as NPV and IRR for the two projects can be shown, evaluated using these figures. And for both projects, the required rate of return is 10%. If the two projects were not mutually exclusive, you would invest in both because they are both profitable. However, you can choose either A, which has higher IRR, or B, which has the higher NPV. So it depends on you what you pursue, to have a higher IRR or to have a better NPV. IRR means you receive your money back earlier. You can reinvest. The concept of IRR have an embedded assumption that you can reinvest the money you receive back at the same rate as IRR gain. And whenever the NPV and IRR rank two mutually exclusive projects differently, as they do in this example, you should choose the project based on NPV. Why? Because project B with higher NPV is better of this reinvestment assumption. Mathematically, whenever you discount a cash flow at a particular discount rate, you are implicitly assuming that you can reinvest the cash flow at the same discount rate. In the NPV calculation, you use a discount rate of 10% for both projects. In IRR calculation, you use a discount rate equal to the IRR, that is 21% for the project A and 18% for the project B. Can you reinvest cash flows from the project at 10% or at 21% or at 18%? It's always the questions. So when you assume that required rate of return is 10%, you're assuming an opportunity cost of 10%. So you are assuming that you can either find other projects that pay 10% return or pay back your sources of capital that cost you 10%. The fact that you earned 21% on the project A or 18% on the project B does not mean that you reinvest future cash flows at the trace. In fact, if you can reinvest future cash flows at rate of 21% or 18%, this should be have been used as your required rate of return instead of 10%. Because NPV criterion used the most realistic discount rate, the opportunity cost of funds, the NPV criterion should be used for evaluating mutually exclusive projects. And also it can have a multiple IRR problem. For conventional projects that have outlays followed by inflows, negative cash flows followed by positive cash flows, the multiple IRR problem cannot occur. However, for non-conventional projects, such as example in this slide, the multiple IRR problem can occur. The IRR equation is essentially an nth degree polynomial. An nth degree polynomial can have up to n solutions, although it will have no more real solutions than the number of cash flow signs changes. For example, a project with 2 sign changes could have 0, 1, or 2 IRRs. Having 2 sign changes does not mean that you will have a multiple IRRs. It just means that you might have it all. And unfortunately, most capital budgeted projects have only 1 IRR. Analysts should always be aware of this unusual cash flow patterns that can generate the multiple IRR problem. Here is the example. You can see that with discount rate, we have 2 possible IRRs that brings your NPV to 0. That's equal to the finding the IRR value. And how it's always dealt using the Excel, you should put some assumptions about what IRR you expected as an optional parameter in your IRR OVSD in Russia function used. And there is also possible to have an investment project with no IRR at all. Just imagine this cash flow: plus 100, minus 300, plus 215. And the IRR for this cash flows should satisfy this equation. And for this cash flow, no discount rate exists that results in 0 NPV. So you cannot imagine any realistic IRR that can bring this sum to 0. Does this mean this project is bad investment? In this case, the project is actually a good investment. The NPV is positive and for all discount rates. So that means we just cannot have any IRR because it's always positive NPV. Yeah, here the project is profile of no IRR. So at any discount rate, the cash flows is enough to never bring the NPV to 0. That's why no IRR here. Payback period. The payback period is the number of years required to recover the original investment period. Very simple, but it has a drawback that is transparent. Since the cash flows are not discounted, the project required return, the payback period ignores the time value of money and the risk of the project. So additionally, payback period ignores cash flows that occurs after payback period is reached. For example, if you invest 10 million in a project, how long will it be until you recover the full original investment? And this table show the calculation of payback period by following investment cash flows and cumulative cash flows. In the first year, the company received 2,500 of original investment with 7,500 still unrecovered. You can see that the company recovers its original investment between year 3 and year 4, and after 3 years, 2,000 is still unrecovered. Since the year 4, cash flow is 3,000, and would take 2/3 of year 4 cash flow to bring the cumulative cash flow to 0. So the payback period is 3 years plus 2/3 of year 4, or roughly 3 years and 8 months. The drawbacks were very simple. In this example, year 5 cash flow is completely ignored in the payback computation. You see that you have no effect on your decision that the year number 5 brings you additional money. And let us consider various projects A, B, C, D, E, F. And we have cash flows for each of these projects. The required rate of return is 10. And let us try to answer the things. What the solution, the payback period criteria gives us if we consider only project A, we compare project B to project C, project D to E, D to F, etc. So the project A does indeed pay itself back in 1 year. However, this result is misleading because the investment is inappropriate with negative NPV. You pay 1,000 today and receive the same 1,000 in a year. Yeah, supposing that the required rate of return is 10, it means that given the time cost of money, you have a negative NPV. For the problem number 2, projects B and C have the same payback period and the same cash flow after the payback period. The payback period does not detect the fact that project C cash flows within the payback period occur earlier and result in a higher NPV. So here the payback period criteria is relevant between the projects with the same total sum of cash flows, but if in one project we receive money back earlier, it's not account for the, again, time value cost of these cash flows. Solution for problem 3, projects D and D illustrate common situation. The project with shorter payback period is less profitable project, and the project T has a longer payback and a higher NPV. And in the case 4, project Z def illustrate the important flaw of the payback period, that the payback period ignores cash flows after the payback period is reached. In this case, project F has a much larger cash flow in year 3, but the payback period does not recognize this value. The payback period has many drawbacks. It is a measure of payback and not a measure of profitability. By itself, the payback period would be a dangerous criterion for evaluating projects. Its simplicity, however, is an advantage. The payback period is very easy to calculate and to explain, and the payback period may also be used as an indicator of project liquidity. A project with a 2-year payback period may be more liquid than other project with a longer payback. Because it is not economically sound, the payback period has no decision rule like that of NPV or IRR. If the payback period is being used, analysts should also use an NPV or IRR to ensure that the decisions are also reflect the profitability and projects being of the projects being considered. And I should say, from my experience, Nevertheless, this drawbacks of the payback period is heavily used in analysis of projects by top managers. Because one of the most common questions the top managers or even the stakeholders or business owners asking while considering the project purpose, when I get my money back. They really didn't account at this point about when I get my money back, considering the time value cost of money. They just want to know when they receive their money back is back in nominal terms. That's the case in the real world. And we have a discounted payback period. The discounted payback period partially addresses the weakness of the payback period. And this table gives an example of calculating the payback period and discounted payback period. And this example is also assumes a discount rate of 10%, and you can see that the flow of the simple payback period is managed by having this discounted payback period. But still, there is a drawbacks for discounted payback period. The discounted payback period relies on discounted cash flows, much as the NPV criterion does. And if a project has a negative NPV, it will usually not have a discounted payback period since it never recovers the initial investment. The discount payback period does account for the time value of money and risk within the discounted payback period, but ignores cash flows after the discounted payback period is reached. This drawback has two consequences. First, the discounted payback period is not a good measure of profitability because it ignores these cash flows. Second, another idiosyncrasy of the discounted payback period comes from the possibility of negative cash flows after the discounted payback period is reached. It is possible for a project to have a negative NPV, but to have a positive cumulative discounted cash flow in the middle of his life, and thus a reasonable discounted payback period. The NPV and IRR, which consider all of the project's cash flow, do not suffer from this problem. And lastly, from this set, we have an average accounting rate of return. To understand this measure of return, let us use a numerical example. You see a company that invests 200,000 in a project that is depreciated, straight line over 5 years to zero salvage value. Sales, revenues, and cash operating expenses for each year are shown in this table. The table also shows the annual income tax at the 40% tax rate and also net income. For the 5-year period, the average net income is 18,000. The initial book value is 200,000, declining by 40,000 per year until the final book value is 0. The average book value for these assets is 200,000 minus 1 or minus 0 divided by 2 is 100,000. So the average accounting rate of return is 18%. So it's an average return on the average book value of your assets involved. The advantages of ARR is that it is easy to understand and easy to calculate. The AAR has some important disadvantages, however. Unlike the other investment criteria discussed, the AAR is based on accounting numbers and not based on cash flows. This is an important conceptual and practical limitation. The AAR also does not account for the time value of money, and there is no conceptually sound cutoff for the AAR that distinguishes between profitable and unprofitable investments. The AAR is frequently calculated in different ways, so the analyst should verify the formula behind any AAR numbers that are supplied by someone else. An analyst should know the AAR and its potential limitations in practice, but they should rely on more economically sound methods like NPV and IRR. To sum up, we should say that nevertheless, NPV and IRR is most common used measures of attractiveness and profitability for investment. And we have also profitability index that is closely related to the NPV concept. It is the ratio of present value of future cash flows to the initial investment, and the NPV is a difference between the present value of future cash flows and its initial investment. So it's a very clear equation, like profitability index equals 1 plus the ratio of NPV to initial investment. And if we transform the investment decision rule of NPV into that of PI, so it will be as follows: invest if profitability index is greater than 1, and we shouldn't invest if profitability index is less than 1. The profitability index indicates the value you are receiving in exchange for 1 unit of currency invested. And although the profitability index is used less frequently than the NPV and IRR, it's sometimes used as a guide in capital rationing, which we will discuss in later sessions. And the PI is usually called and used in corporations, but it's commonly referred as a benefit cost ratio for governmental bodies and not-for-profit organizations. And here a very interesting table showing the popularity and usage of these various selection criteria. So analysts need to know the basic logic of the various capital budgeting criteria and investment project assessment criteria, as well as the practitionalities involved in using them in real corporations. Before delving into the many issues involved in applying this concept, I'd like to present some feedback on their popularity. You can see the usefulness of any analytical tool always depends on specific application. Corporations generally find this investment criteria useful. 2 surveys by Graham and Harvey in the year 2008 and Broden, de Jong, Kudlik in 2004 report on the frequency of their use by United States and European corporations. These tables give the mean responses of executives in 5 countries to the question: how frequently does your company use the following techniques when deciding which projects or acquisition to pursue? Although financial textbooks or academician studies preach the superiority of NPV and IRR techniques, it is clear that several other methods are heavily used. You can see in 4 European countries, the payback period is used as often as, or even slightly more often, the NPV and IRR. And I should advocate for this. Yes, in Russia, we also used payback period very heavily. These 2 studies mentioned earlier, large companies tended to prefer NPV and IRR over a payback period. And the fact that US companies were larger on average partially explained the greater US preference for the NPV and IRR. So other factors influencing the choice of capital budgeting techniques, what can it be? Probably private corporations used the payback period more frequently than did public corporations. Companies managed by MBAs had a stronger preference for discounted cash flow techniques. And of course, any survey research also has some limitation. In this case, the persons in these large corporations responding to the surveys may not have been aware of all the applications of these techniques. So how we can interpret this, the results of this survey? So the greater, the larger the corporation you are working for, the more experienced and educated you are, the more aware you are of the different techniques can be used to measure the profitability of the project, the more likely you will have and use NPV or IRR. But if you are a smaller company with not so educated staff, you should speak on a language that can be easily understood by your employees and by your owners. If they cannot grasp instantly the concept of net present value or IRR, just put it in simple words: the payback period, the time when you get your money back, and it's clear for them, and it's raises the chances that your proposal will be accepted. So again, drafting project proposal, preparing financial models, evaluating effectiveness of the project. Always keep in mind, you should speak on a language of decision makers. Okay. We have few slides on other types of profitability measure, and we can say a few words about the common pitfalls for capital allocation or for project selection. But I would like to take this time to show you the Excel file with the description of tasks to be made and the example of how it can be made, while the questions of other proficiency measures and the common pitfalls of investment criteria and decision-making process we can discuss in the next lecture. And let me switch to this test file. Sorry. Wait a minute. Convenient. Okay. That's the description of the situation for the test, but let's start with an example how this test can be done. So it's a different situation, but it will give you understanding what this test is all about. We have the data, so the input data for the model to build, and at the end of the day, we have to calculate the various profitability measures like NPV or IRR and suggest on the decision, should we invest in this project or not. So we have an investment outlays of 200,000 of fixed capital items. It includes 25,000 of non-depreciable land, and the rest is for equipment that will be depreciated. Straight line to zero for 5 years. Investment in the net working capital, net of the investment in short-term assets required for the investment, and this the investment is receivables and inventory needed. So less short-term payables generated by the project, and in this case, it requires 50,000 of current assets, but generated 20,000 in the current liabilities. That results in investment in a net working capital for 30,000. So the total investment outlay at the time x equals 0 is $330,000. Then on the revenue side, we have a sales of 220,000 each year, and the cash operating expenses of 90,000 each year. Depreciation of that is equipment equals 35,000. That is 1/5 for the whole period. The result is operating income before taxes that equals 95,000. Then applying income tax at 40%, we have 38,000, and that leaves income after taxes equals 57,000, and then adding back the depreciation, so that is not cash item, give us the cash flow that equals 92,000 for each year. And at the end of year 5, the company sells out the fixed capital assets, and in this case, the fixed capital assets, including the land, will be 50,000. That is 25 for the land, and which represents the gain of additional 25,000 over the remaining book value. So the gain of this 25,000 will be also taxed by 40%, resulting in tax equals 10,000. That leaves 40,000 as cash effect of the fixed capital as release, and additionally the net working capital investment of 30,000 is recovered, and short-term assets, short-term liabilities no longer needed for the project. So we finally have the terminal year non-operating cash flow at 70,000. Let us calculate and put it all in a financial, very simplistic financial model. So what we have here, we have calendar years, project years. We have some assumptions like discount rate, income tax. I put it all in one page here because we have a very simplistic model, but if you have a very complex model, we should devote a special page for all the assumptions. We have again the composition of initial outlay. We have pro forma cash flow statement starting with some proxy for operating income after taxes that can be derived directly from this figure, so taking from P&Ls, and some non-cash back adjustments can not cash adjustments should be made. So just consider the formulas that we have here. You can see what is the input figures, like numbers without formulas. Then we have formulas, again formulas. So you can easily check what is the input and what is the calculations and what is the outputs. And then we have after-tax cash flow calculated. We have discount factors, factor values. It's also formulas. The discount after tax cash flow, and finally net present value at the given discount rate and the internal rate of return. That's the calculation. That's the NPV. That's IRR. Very simple. I think it shouldn't be a problem for you, but if you will have any questions, please don't hesitate. We'll have enough time to complete the test. I will not ask you to bring and send me all the results of your tests by next session. It will be the session in 2 weeks, so you really have 2 weeks to work on this, and we will also start our next session again recalling the investment criteria we passed, and then going through investment criteria we haven't passed, and you will have a time to raise any questions for me, and I will answer. So I will put now this file in a chart, and here's the description of your task. So what I'm asking of you to create a similar performer model. So with assumptions section, with years, with calculations, with results, and answer on these two questions. So determine whether this is a profitable investment, and what would be if the tax rate increased to 40% and the required rate of return increases to 13%, will the project still profitable or not? And I should ask you to try to make it as parameterized model. So please do not have these values like 13% or 40% embedded in your formulas. Try to put it as a separate cell, what you can change, and use in the formulas below as a reference to this cell, like here. Okay? No problem with that. Any questions? Please let me know, do you get all the stuff from today's session? Do you have any questions? Okay, I will also send the presentation with a few additional slides that we haven't passed, along with this test. Also, sorry, I should close it. Also via email, using the this extensive list I had from the previous lecture. Okay. Yeah, so the task and the slides with investment criteria, etc., will be also sent by mail. Fine. So thank you for your time. Have a good weekend. Please rest, be fresh, be healthy. Thanks a lot. See you in a week. Yeah. So bye-bye.